Calm markets, hidden stress, how the trade war evolved from shock to system. Introduction: when silence replaces fear. Financial markets have an instinctive relationship with fear. They spike when uncertainty explodes, collapse when confidence breaks, and recover when risk is resolved. But there is a fourth condition, rarer, quieter, and far more dangerous. When markets stop reacting not because risk has vanished but because it has become familiar. The recent phase of global trade tension illustrates this condition perfectly. Tariff threats escalate, deadlines were announced, sectors were named, and yet markets barely moved. Equity indices stabilized, volatility remained contained, investors didn't flee. There was no dramatic repricing. This calm was widely misread as resilience. In reality, it marked adaptation. And adaptation is not neutral. It redistributes power, concentrates control, and transfers cost downward through system. And today, I will be explaining it how it has got it has transformed from shock to normalization, from normalization to consolidation, and finally from consolidation to controlled equilibrium, with primary focus on markets, trades, commodities, finance, labor, and power. Chapter 1: From shock weapons to background noise. Tariffs once functioned as disruptive events. They were episodic, politically costly, and economically destabilizing. Markets treated them as anomalies, temporary distortions in an otherwise integrated global system. That assumption is no longer valid. Repetition eroded surprise. Threats became patterns. Investors learned the cadence: announcement, negotiation, delay, partial enforcement, carve out, legal challenges over time. Markets stopped trading the rhetoric and began trading only executional risk. This was not complacency, it was learning. The absence of panic doesn't imply the absence of danger. It implies that danger has been absorbed into expectations. Once that happens, volatility collapses. Not because the system is healthier, but because it has learned how to live with friction. This marks the first transition. Tariffs ceased to be shocks and became background conditions. Chapter 2: The Structuralization of Tariffs. The most critical shift in this cycle is not political, but fiscal. Tariffs has quietly Tariffs have quietly transformed from bargaining tools into revenue infrastructure. Once governments experience sustained tariff inflows, incentive changes. What was once framed as temporary leverage becomes normalized taxation. Baseline tariffs spread across imports. Strategic sectors face permanent surcharges. Tariff friction hardens into policy. Markets understand this instinctively. They do not assume reversal, they assume continuity. This explains why equity markets remain stable even as tariffs rhetoric intensifies. The expectation is no longer resolution but permanence, and permanence, unlike shock, can be priced in. The danger lies not in tariff itself but in the secondary effects set in motion, effects that unfold slowly, unevenly across the system. Calm markets, moving capital. Chapter 3: While Western equity markets appear indifferent, capital behavior tells a different story altogether. Calm on screens masks, masks movement underneath. Supply chains are being renewed. Production is being diversified. Firms are reducing single country exposure and building redundancy into logistics, sourcing, and manufacturing. Southeast Asia absorbs capacity. India emerges as a structural hedge. China adapts by exporting capital rather than goods. This is not diplomatic hedging, it is strategic repositioning. The goal is no longer maximum efficiency, it is survivability pardon, under persistent friction. Redundancy replaces optimization. Resilience replaces speed. These shifts do not trigger market crashes, they trigger slow reallocations. Capital rarely panics when it can move. Commodities as the early warning system. Equities are narrative driven instruments. They remain calm long after stress has entered the system. Commodities cannot. When tariffs intersect with critical inputs, copper, energy, industrial metals, the impact is immediate. These markets react not to sentiments but to physical constraints. Import dependence translates directly into price pressure. Price pressure compresses margins. before consumers feel inflation. This sequence matters. Input costs rise, margins compress, investment slows, hiring stalls, defaults increase. By the time equities respond, the damage is already embedded. Commodities reveal what markets prefer to ignore. Stress arrives quietly, not theatrically. Chapter 5: Finance profits first, industry pays later. Periods of uncertainty are not universally destructive. For financial institutions, volatility is often profitable. Trading volumes rise, hedging demand increases, fee generation accelerates. This creates a deception signal, strong bank earnings during systematic stress. Regulatory institutions have already flagged the asymmetry. The Bank of England has warned that sustained trade friction could increase corporate defaults. The European Central Bank has highlighted the overlap between trade risk, security risk, and financial stability. The implication is structural. Finance extracts value early, industry absorbs pressure later. This is not failure, it is architecture. Chapter 6: The Quiet Accumulation of Corporate Fragility. Corporate stress doesn't announce itself with headlines, it accumulates invisibly through balance sheets and operating decisions. Borrowing costs edge higher, expansion plans are postponed, capital expenditures are delayed, hiring freezes replace layoff. Farms do not collapse, they thin. This is the most dangerous phase because it cannot provoke reaction. Markets tolerate it, policymakers defer response, risk compounds. Defaults rarely begin with panic, they begin with silence. Chapter 7: Shadow Banking, the Hidden Load Bearing Layer. The most significant system vulnerability lies outside traditional banks. They exist in the vast, opaque ecosystem of non bank finance. The Financial Stability Board has repeatedly warned about the scale and opacity of shadow banking, hedge funds, private credit, structured vehicles, and off-balance sheet leverage. This sector doesn't benefit from the same backstops, transparency or regulation as banks. When stress finally breaks something, it is likely to emerge here, not visibly, not cleanly, but through cascading failures in instruments few understand. This is why calm markets are misleading. The fault lines lie below visibility. Trade as infrastructure, not ideology. Chapter 8: The modern trade conflict is not ideological theater, it is an infrastructural contestation. contestation. Ports, shipping lanes, logistics hub, energy routes, commodity flows define power far more than speeches. Container ships are not metaphors, they are mobile units of economic force. Who controls trade infrastructure controls pricing power. Who controls pricing power controls margin. Who controls margin controls survival. Markets understand this hierarchy. This is why they remain calm when infrastructure is quietly reorganized. Chapter 9: Adaptation transfers cost downward. Adaptation is not neutral, it redistributes burden. As systems stabilize under friction, costs are passed downward, from finance to industry, from industry to labor, from labor to society. Automation accelerates, workforce redundancy increases, human presence fades from the production flow. The system survives, people adjust. This is not collapse, it is absorption. Once adoption completes, power concentrates. Fewer actors remains viable. Those with scale, insulation, and access to capital strengthen. Smaller firms disappear or are absorbed. Markets interpret this as stability. In reality, it is consolidation. Capital flows upwards, control narrows, volatility declines. Not because risk has vanished, but because decision making has become centralized. The system doesn't heal, it stabilizes under fewer hands. The end state is not chaos, it is control. Global systems reach a point where outcomes feel inevitable. Algorithm regulates flows, institutions manage risks, markets function without visible stress. The noise fades. This is not peace, it is equilibrium enforced by structure. At this stage, even fear disappears, not because danger is gone, but because everything has been priced in. Conclusion: Calm is not safety. The greatest error is to confuse calm with strength. Markets are calm because they adapted to friction, normalized tariffs, rerouted supply chains, and absorbed uncertainty into structure. They are not resting, they are preparing. The next disruption will not come from surprise, it will come from accumulation, from pressure that built quietly while attention drifted. Calm markets are not the absence of risk, they are the signal that risk has become systematic, and systematic risk doesn't explode. It consolidates, stabilizes, and only then it reveals its cost. This is the phase the world has now entered officially.